Hello to everyone. Here is a short presentation about equity in startups in English with a strong French accent. My apologies for this. So let's begin about what is really important when we talk about equity split, equity sharing in startups. So let's first take a famous example. Here is how Google was structured at the time of the IPO, the initial public offering in 2004. You see two founders, Larry Page and Sergey Brin, who had exactly the same number of shares. It looks a little strange to have such a complex number, but I will come back to this. What is important is they both own 14.2% of their company at the IPO 6 years after the founding. The Series A. Series A means really the first round of investors were made mostly of business angels like Jeff Bezos, the famous founder of Amazon.com, David Sheraton, who was also a professor at Stanford University, which is the reason I'm using the same color for the founders and the professor, and Andy Bertelsheim, who is a famous entrepreneur from Silicon Valley. He was the founder of Sun Microsystem. There were other founders, and together they had about 15 million shares. You see that the three most famous business angels had 1.6 million shares. They had invested each $100,000. Stanford University is listed here because they had licensed their technology in form of a patent and probably some software, and they had about 1.8 million shares. So these were the Series A investors. And even if Stanford was probably not an investor, but just a licensor of technology, and in exchange he had at the IPO 0.7% of the company. The Series B, so the second round of funding, happened about 6 months after the first round. I think the company was created in September 98. The first round was in October 98, and the Series B was, if I remember correctly, in May 99. It was 47 million shares, representing 17% of the company at the IPO, and it was a round of $25 million. Both Kleiner Perkins and Sequoia, two of the most famous venture capital funds in Silicon Valley, had about 23.8 million shares. The Series C happened a few years later. It was only 6 million shares, despite the fact it was 15 million investments. And what is really interesting with Google, and maybe I will change the color of my mark here, is this others representing 4.40% of the company. These were mostly the employees, like, for example, Eric Schmidt, who was the CEO who joined the company about 3 years after the founding of the company. Omid Kordestani was the VP of sales. He had 1.8 million shares, whereas Eric Schmidt had about 5.4 million shares of the company. When you go public, usually you sell shares at the IPO, and these represented 5% of the company, and a strange number again, 165 shares. If you try to understand what this number is, you should remember that Brin and Page were geek, and maybe you will recognize these figures in this number, just like the total number of shares. It may remind you something which is pretty famous. If I remember, I will mention it at the end of the presentation. The total is 100% of the company. So basically, you see that the shareholding of a company is made of its founders, the early and later stage investors, and the employees. That's how Google was structured, but of course this was a history from founding to IPO. It took 6 years. So now I will try to explain through a fictitious example, how these things can develop over time. So I'm taking an example. A professor has a PhD student in his group. They have good results of the research, so they decide to create a startup, and the professor knows an experienced business person who could join to help on the business side that maybe the professor and the PhD student don't have experience with, and maybe they have discussed for 6 months, 1 year. They decided that really everything is going well, and they decide to create a startup altogether. together. So how should they split the equity? And that's not an easy question. If this is done badly, there will be frustration, and this may be the best way to destroy trust and even some value in the company. So I will let you think about, for a few seconds again, what may be important when you're thinking about creating a startup, what should be taken into account, and there are many parameters. And you may be surprised by what is considered as important, but again, take a few seconds about what you would believe if you're a PhD student, if you're a business person, if you're a professor, you may have totally different point of views, and this may be interesting. So, first, there's no single answer, and you should remember that. I think what is really important is the future commitment, the expertise you have, the credibility. The credibility means, well, if the professor is a Nobel Prize, he's bringing a lot of credibility to the firm because of his name, right? So maybe the science, the technology is developing has a lot of importance. The expertise is more what you know from what you're bringing to the startup, and the future commitment is slightly different. Will you bring, like many investors are saying, your sweat, your blood, and your tears in the startup may be important. What may be a little strange is the past contribution is not so important. If you bring something to a startup and you don't commit to it, this is more static, and everything is dynamic in a startup. So you should remember this element. And of course, you will take into account the past contribution, but it's not so important. For example, in the past contribution, if there's IP, intellectual property belonging to a university, like we have seen with the example of Google, there may be a license to give the rights to the startup to develop its technology, and maybe the academic institution will take equity. It's not always the case, but it's more and more common. So this is an element of past contribution to the startup creation. A term which is fundamental is vesting. Whatever happens to the people owning equity in the startup should only be final after a few years, because if one of the founders leaves the startup after a few months or even a few weeks or a few days, should she or he keep the equity? Probably not, right? So the idea is, if you have a 4-year vesting period, you keep 100% of your shares after 4 years. If you stay only for 2 years, you will keep half of it. If you stay for 3 years, it will be 3/4, and maybe 1 year, 1/4. And I think it's pretty fair to commit to something in advance and then keep what you have in for the time of the vesting. Finally, I always claim that, and I will change the color, the money invested is a dangerous element, because if you're rich, and if you're, for example, you decide to create a company with $100,000, and you need to have 20% of the company to commit $20,000. If you're a young PhD student, you may not have that money, and you may have paid for many tuition fees already in your life. You cannot be in debt anymore. So let's consider the money invested is not part of this element, and this will be left to the future financing rounds, like, for example, the first business angels that were mentioned in the Google case. If you're curious about equity and academic institutions, you can go back on my blog, and I put some information about this element. There is a little book called The Slicing Pie, which is helping a lot in terms of sharing equity in between people who have committed to invest some of their time. So if you decide to work for 6 months before deciding if you will create a company, if someone is working full-time, someone else is working 20% of his time, and someone else only in the evenings and weekends, maybe you can count the number of hours, maybe you can count the different contributions in the technical development, or maybe in the business plan writing, and this may be important. The book is a little complex, but it's a nice little book, and if you're really interested in that element, you may go to the website and buy the book. But there's a way to quantify maybe the idea of equity sharing. It's coming from a website from Carnegie Mellon, the university on the east coast of the US. And the idea is the pie calculator. So let me try to explain what this is about. Well, for all the elements which may be important for the contribution to the startup, like we said, the past contribution. So the past contribution may be the idea to the solution, the expertise, which is slightly different from the credibility, and of course the commitment and the responsibilities you will have in future startups. You may consider that all these elements are important. The business plan is in a way part of the expertise and also describing the idea. So you put a weight to these different elements. So here I decided that maybe there's as much importance given to the past contribution as the commitment. Something I didn't mention is also the risk, because if you are quitting a good job to go to a startup, you are taking a lot of risks. Maybe if you are finishing your PhD, you have an offer from Google, you decided not to go there but go to the startup, you are missing an opportunity, and that's also risk-taking. But if you are, for example, a professor not leaving his position, maybe the risk is 0. So I put also the same weight to risk. And finally, maybe it's not so obvious, but 5 plus 2 is also a weight of 7, which I combine in the expertise and business plan. And then in all of these dimensions, maybe you can allocate 10 points between the 3 founders in our story. And for example, for the past, you may consider that the PhD student worked a lot for 5 years of his life, full-time on the idea. So I gave him 8 points, whereas the professor was more advising and he has a little less. But on the other side of in case of expertise, credibility, maybe the business person and the professor have much more. In terms of risk-taking, like I was saying, maybe the risk is only taken by the PhD student and the business person, and so on. So you multiply the grade by the weight, you do the sum, and in the end you arrive at these 3 total out of maximum total of 280. So if you do the ratios, you obtain 47%, 18%, and 36% of the initial sharing. Of course, this is only a theoretical exercise. My advice is, when you are many founders, do the exercise yourself in the side, and then share your ideas with your co-founders and see what happens. If the numbers are the same, you have agreed, you have an equity share. If you don't, then take a few beers or your favorite drinks, and then you may go and try to converge on something better. So after these drinks, our 3 founders have agreed. Finally, they arrive at 45, 25, and 30%. If they decided to create a total number of 10 million shares, this is totally artificial. It could have been 1 million, 100,000, or 1 trillion. Why not? Of course, the ratio would be the same. We have our 3 person, and they even decided to give themselves titles like Chief Technical Officer, Chief Scientist, and VP BizDev. Although I tend to say you shouldn't give yourself title. So maybe sometimes professors have too much power, because why did he go from 18% to 25%? Maybe he has a lot of influence on his student who agreed to diminish his elements. And again, beware of titles. What do I mean by this? Well, I took a slide from famous Steve Blank and his 4 steps to the epiphany, or his startup handbook guide. And he is claiming that to give titles to founders like VP Engineering, VP BizDev, VP Marketing, VP Sales is a mistake. You should have maybe a function of technical visionary or business visionary, or maybe business execution. Maybe there's still a CEO to take decisions, but in the end, all the founders should go in front of customers. So don't give yourself 2 strict functions where you could maybe sometimes criticize your founders when they have not done the job. It should be the job of a group when you create a startup. Talking about, and if you want to mention these titles, you can go back on my slide on title in startups. Coming back to the powers of professors here, I met this woman, Penny Schiffer, who was at the time at Swisscom Ventures. She was surprised when I said to a jury of startups that professors shouldn't have, for example, 30% in equity if they are not active in the startups, if they are just maybe advisors or chief scientists. And because she was not sure, she did a quick survey on Twitter asking the question, professors, co-founders, which equity percentage is fair if a startup kicks off in a lab, but the professor has no active role? And she was surprised to see that out of 51 votes, only 2%, so only 1% was thinking 30% was okay. A vast majority was thinking it should be between 2 and 5%. Some, about 20%, so 10 people, were thinking 5 to 15% is fair. On some of them, 15% were even thinking, there's no reason if he has no active role to give him any share because it's not his IP, and maybe the IP should go to the research institution. So if I take this percentage and I weight them with the intervals that were given here to 5%, 5 to 15% here. If I do a weighted average, I arrive at 3 to 7%, which is very far from the 18 and 25% I have in my example. So you should remember that equity goes mostly to the people who have an impact in the future startup. If there's a VC round, well, this doesn't happen all the time. Sometimes you don't need even investors. If you look at Logitech in Switzerland or Microsoft or Oracle in Silicon Valley, you don't see much investments. And some companies manage to grow only with their customers. You call this bootstrapping your company, but still, if you don't have a product ready yet, maybe you will need some investment. So in our case, our founders know a VC, a venture capitalist, who proposes to invest $1 million for 40% of the company. Remember, you will always say to investors how much money you need for the next 6 months, 2 years, 3 years. It depends what they are ready to help you in terms of timing. But they will offer a valuation of the company. So if it is 40% for 1 million, it means that the value of the post-money value of the company is $2.5 million. But they add something quite important. They want you to reserve shares, future shares, for your employees, what is called the ESOP, or employee stock option plan, which are options given to employees which give them an opportunity to buy shares. It's something technical, which is not the topic of this presentation, but usually when you have an option plan, you can grant options to your employees. They will be the same vesting mechanism of 4 years. So these options will only have a possibility to be converted into shares in a timing manner. So after 2 years, you will be allowed to transfer them in shares only 50% after 2 years and 75% after 3 years, and all of them after 4 years. There's even something a little more technical, which is a 1-year cliff, which means you are not allowed to convert your options, any of your options, in the first year. So if you leave after 9 months, you are not allowed to have any shares. But if you leave after 1 year and 1 day, then you are allowed to convert 25%. So converting is as another technical term, which is exercising. So you pay for your options at this time, and by paying for them, you're allowed to exercise them as shares, and then you receive usually what is called common shares, ordinary shares, whereas in fact investors will have preferred shares with many rights. Again, that's not the point of my presentation here, but VCs usually offer what is called a term sheet, which is describing what the investment would be, and it's much more than just 1 million for 40%, but it's many rights, like things like liquidation preference, anti-dilution preference, tag along, drag along, control mechanism of the board, and if you're interested, you may have a look at these things. Something quite important too is there may be a fiscal impact related to vesting or exercising, depending on in which countries you are, if it's in the US or the UK or France or Germany or Switzerland, it may be different. So after our VC round, called the A round, we consider our startups as now 7 employees. So you see there were only 2, of course, initially, the PhD student and the business person. The professor is not an employee, and we have 7 people. We still have the shares of our founders, which I put here with a small f. You still see the 4.5, 2.5, and 3 million shares. So there were 10 million founding shares. If the investors had 40% of the company and 20% have been reserved in terms of options, of course, it remains only 40% for our founders. So that's a total of 100%. So 40% is also 10 million shares for the investors, and half of that, 20%, are the stock options, 5 million, which are not real shares. They are the possibility of being converted into shares. This is not the real capitalization table, cap table of the company, because it does include virtual shares, and this is called the fully diluted capitalization table of the company, but it's important to remember these elements. 4% or 1 million of the stock options have been given to our new 5 employees, and 16% remains available for the future employees. So that's now the table after the first round of funding. Usually in a startup, you don't stop with the first round. There may be some B and C rounds, so they are just new rounds. If my seed or A round was in 2007 with 10 million shares for $1 million investments and 40% ownership, well, one other element that I hadn't mentioned is if 10 million shares represent $1 million, it means each share had been paid 10 cents, right? 10 cents times 10 million is exactly 1 million. And then there's a second round in January 2008, a third round in October 2009. Maybe they were made of $10 million and $15 million, so we have a total investments of 26 million. But hopefully the price per share will increase, which means the valuation of the company is increasing, not only because of the number of shares, but also because of the price per share. That's the idea of value creation in startups. So in our example, the price per share of the second round is $1.1, so 11 times bigger. And then the price per share of the third round is $3.61. If you divide the amount by the price per share, of course, you have 9 million shares and 4 million shares, which give a total of 23.2 million shares of what is usually preferred shares, the shares of the investors, which have special rights. So we have now a much more complex table. I am aware of that, and I'm sorry, but what you can see is, we still have our 3 founders with exactly the same number of shares. This doesn't stop. We have our investors who have a total of 23 million shares, which represent apparently 55.9% of the company, whereas our founders have much less. In fact, they have 10 million, and this represents 24.1% of the company. The company has grown from 2 to 7 to now 70 employees. And what is important is what is remaining, which is the total number of options, 8.7%. Why does it look smaller? Well, because there are also managers which have been hired. There's a CEO which has apparently 7.2% of the company through his 3 million shares. We have a VP in sales and marketing, a VP engineering, a VP products, and a chief financial officer who has 0.5% of the company and 200,000 shares. If you were doing the sum of all the managers and the stock options, you will arrive at a number of, about 44% minus, of course, the founders in our company. Usually, what happens in a startup is non-founder employee shares and options are maintained to 20, 30%. Remember, Google was even 40%, but Google had a very big number of employees, like we will see at the end of my presentation. A useful rule of thumb is when you're trying to think about how much equity you give to future managers and employees, there's a nice rule of thumb which I like to use. It's not maybe perfectly right, but you should consider that a CEO should get about 5–10% of the equity close to the IPO. The VP, the level below, is more 5 times less. So there's a kind of 5x hierarchical scale, so 1 to 2%. The senior people will have 0.2 to 0.4%, and if I divide again by 5, the junior people will get 0.04 to 0.08%. And this is helping because if you want to look at the growth of your company, if you take a small startup with 20 employees, with 1 CEO, 2 VPs, and so on, and you give them the high value of my interval 10% for the CEO, 2% for the VP, and so on. If you do the computation, you will arrive at 16% in total for a 20-person startup. If the startup is growing to 100 people, and then maybe the allocation is slightly lower, but let's say the middle value of my range above, then you will arrive at 28%. And if you're a bigger startup, maybe close to what was Google at the IPO with 501 employees, and again now you take the lower range, 5%, 1%, 0.2%, and 0.04%, you arrive at 43% of the equity dedicated to the employees. Well, if there's an IPO, this doesn't happen often, as you know, but usually companies go public when revenues and growth are steady, maybe with an exception in biotechnology where revenue and profits are lower, but still there are good signals that the company has extremely good results. The company will raise additional money to further grow. There are IPOs when you don't raise money, but the idea of an IPO, it's a new round of funding. It also brings liquidity to founders and investors, because they will be allowed to sell some of their shares at least after what is called a lockup period, which lasts usually 6 months after the IPO. And of course, you use an investment bank, which is taking a fee, which is about 6 to 8% of the money you raise at the IPO. Google, again, was a special case. They had decided not to take any bankers to organize the IPO, but this is, again, an exception. Something which is worth discussing is what is the exercise price of stock option. I mentioned that an employee is allowed to pay for his stock options, and when he pays for them, in fact, he's exercising them, so he's converting his options into shares. The habit in this pricing of stock option is the following. When you are at the level of a Series A, the startup is still very risky. Investors have strong rights with preferred shares. So usually there's a discount, and the discount is employees pay about 10% of what investors have paid during the Series A. So if the Series A, if you remember, was 10 cents per share, the price per share of the option is 1 cent. At the level of the Series B, the company is less risky, so you are closer to what investors are paying, but still quite far, so it's 30%. It was $1.1, so this means 33 cents. The Series C is closer maybe to a steady and sound company, so the exercise price of stock option at the level of Series C is 70%, 2.52 shares. And why is that? Well, because when a company is going public, after the company is public, the exercise price of stock options which are granted to an employee joining the company after it went public has to be 100% of the price per share when the company is public. So if my company was going public in my example at $20 per share, it should be 100%. So you have this S-curve here from foundation to Series A, to Series B, to Series C, and to IPO, where basically at foundation it's so risky that the price per share could be close to zero, and it happens in many cases for academic institutions. When they do license technology to a startup, they receive in exchange free shares or free stock options, and this is allowed because they have special structures, and then the price will increase steadily, hopefully to an IPO. And if there's an M&A in between, if the company is bought here, but well, the price per share will maybe be there, but the employees will have bought shares at a smaller price and will make a profit on the stake if the company is acquired. So we have now a much more complex company with our three founders. I am using this kind of template in many cases. So I call my company CS, like Computer Systems. It was created in 2006. It's going public after 4 years in 2010. It's in high tech. I did that when I was living in Switzerland, so I based it in Switzerland. I put the revenue growth of my company, which is a fast-growing company, as you see, 20 million in revenues in 2008, sorry, $100 million of revenues, which is a 400% growth in revenues. We have now 200 companies, like we see here, or we see here again. It went from 2 to 200 employees. So the value of the stock on average per employee is $250,000. This table in the middle is about the investment bank organizing the IPO. And you see that we have, again, our managers here. We have our investors who have the shares. Of course, there's a little trick that maybe you are checking, and I was about to count the number of shares for the investors. Remember, it was 23 million shares, and now it's only 2.3 million shares. On my CTO PhD student at 4.5 million shares, and you see now that he has only 450,000 shares. Why is that? Well, for a simple reason. It's because there was a stock split, a 10-to-1 stock split of our companies. This happens a lot, particularly when you're going public. So there are 10 times fewer shares. Of course, it's not so important. It's an artificial exercise, because if the price per share, the IPO, like I said, was $20, in fact, it's $200 now. So if you multiply the number of shares you own by the price per share, the value is exactly the same. And that's what is important in our example. So now you understand why we have our 2.3 million shares for our investors. And of course, what remains is the options on the managers. And this will be, again, about a total of 30%. This is the capitalization of Google at the IPO, and it's a very similar story. You see that there were A, B, C rounds with price per share of 6 cents, 52 cents, and $2.3 at the different dates. This was the 1 billion seed round, 25 and 50 million rounds later in May 1999 and May 2001. You see that the company was created in September 2008 and went public in 2004. It was based in Mountain View, and it went public at $85 per share. Can you imagine the multiple between our three business angels invested $100,000 at 6 cents per share, and now making a multiple, an amazing multiple. Similar with Stanford University, who had 1 million shares, 1.8 million shares with a value of $156 million. In fact, they wait until the lockup, and when they sold their share, it was even 336 million shares. So if you're interested in all these numbers, you can go on my blog, and you would see that they are, in fact, example of 600 former startups with similar cap tables, and you would see the average ownership of CEOs, of VPs, of board members also, which is something I didn't mention, how much investors have. You have data out of these 600 startups on relationships to the fields of activities, depending if it's software, internet, biotechnology, medical devices, or electronics. If we're talking about different geographies from Silicon Valley to the Boston area to Europe or China. And I looked also at the age of the founders and also how many founders are staying as CEOs, which you may be surprised about. I will finish my presentation by something which is not related to numbers, but to values. And I will go quite fast because you will take your time to read this slide if you're interested. But I am claiming that if founders don't have these values, and it's true also that for the managers, whatever you do with the cap table will not be helpful. And what are the values I'm talking about is coming from something called the 5 dysfunctions of a team. So what goes wrong when a team doesn't share the same values, and the values are trust, not being afraid of conflict, being extremely committed to the startup. Remember, the commitment was important, accountability of decisions, and of course, attention to results. So let me go very fast about this, but the idea is, first, you must be genuinely open between founders and don't be afraid of being vulnerable in a group. That's clearly important to build a foundation of a good company. If you have this trust, then you will be capable of unfiltered and passionate debate, not totally useless debates, but sometimes it's important to take your time and agree about things when particularly there are conflicts. Things are not always so simple to face when you're creating a startup. If you're not afraid of debates and trying to solve them fairly, then the commitment will be there. But if you have not agreed with the debates, then you may not be committed and you may feign agreements, which would be totally terrible. So lack of commitment is something you should never miss in a company. And of course, if you're committed with a clear plan of action, then you can account for what you do, and you will not hesitate to use your peer to judge about your own actions and behaviors. And if you are not sure, the best way is sometimes to go for helping for your partners. There's a famous young entrepreneur in Switzerland who said, when I had an issue, I was just trying to hide it and not share it with my partners, and that was the best way for catastrophe because the problems were never solved. So it's important to commit and to account for your own responsibilities, and if you do so, then you will have a strong attention to results and try to see if what you have committed to is bringing good results, and you should try to avoid egos, career developments, recognitions, and politics, which is the best way to make a failing company. So again, truly cohesive teams are really ones we trust one another, engage in unfiltered conflict when it is important to discuss ideas, they commit to decisions and plan of actions, they hold one another accountable for delivering against those plans, and they focus, of course, to the achievements of collective results. So I talk about sharing equity, I talk about the famous example of Google and refer to many example, and I hope that all this will be useful for you. Thanks a lot for your attention.